In this video, we're going to look at recording inventory transactions in the accounts. First, a quick recap on inventory transactions. Are these transactions leading to inventory coming in or going out? Purchase, purchase returns. Sales, sales returns. Capital contribution of inventory. Drawings of inventory. And lastly, inventory used for advertising. Here's an example of inventory purchase. In our inventory card, we can see that we've recorded a purchase of 8 units at a cost price of $60 per unit, totaling to $480. In our general journal, we recognize a $480 debit to the inventory account as this purchase has led to an increase in inventory. A quick reminder here is that there is no GST recorded in the inventory card. Therefore, we need to calculate the GST of 10% on the cost price of $480. In total, we now owe the accounts payable $528 for this credit purchase of inventory. Here's an example of a purchase return. In our inventory card, we can see that we have returned 2 units of inventory to the supplier. In our general journals, we record a credit of $120 to the inventory account. This reflects the decrease in inventory as a result of this purchase return. Another reminder here is that there is no GST recorded in the inventory card. So the GST adjustment as a result of this purchase return needs to be added on, which in this case is a $12 credit to the GST clearing account. The total credit refund from the accounts payable is therefore $132, which is a debit to the accounts payable. When recording a sale of inventory, we need to remember the two parts of a sale transaction. Firstly, the sale itself, and secondly, the inventory movement. In this example here, 3 units were sold for $100 plus GST per unit. In the general journal, we record a credit of $300 to the sales account, a credit of $30 to the GST clearing account, and a debit of $330 to the accounts receivable account because this is a credit sale. And how do we know that this is a credit sale? It's because of the invoice number that has been given to us. Then we record the inventory movement. In this case here, we can see that 3 units of inventory were sold at a cost price of $60 per unit. In our general journal, we record $180 credit to the inventory account because our inventory has now been reduced. And now we recognize the cost price of the inventory sold, and we do this by debiting $180 to the cost of sales account. A sales return is simply the opposite of a sales transaction. We still need to remember that there are two parts of a sales return transaction. Firstly, the sales return itself, and secondly, the inventory movement. In this example here, the customer has returned 1 unit of inventory to the business, resulting in a credit refund of $100 plus GST to the customer. In the general journal, we record this sales return by debiting sales returns account $100, debiting GST clearing $10, and crediting accounts receivable $110. From the source document ID that was given to us, we note that it was a credit note issued to the customer. Therefore, we know for sure that it was not a cash refund that was given to the customer. Instead, this is a reduction of the amount owed by the accounts receivable gift roll by $110. Next, we record the inventory movement. From the inventory card, we can see that the customer has returned to us 1 unit of inventory, with a cost price of $60 per unit. In our general journal, we record this return of inventory by debiting inventory $60 because our inventory has now increased by the 1 unit, and we adjust our cost of sales by crediting the account $60. Sometimes, inventory can be taken out and used for advertising purposes. A very common example is when businesses give out samples. In this example here, the owner has donated 2 pots to the local school to be used in their fundraising raffle. In the inventory card, we can see the 2 units taken out have been recorded in the out column, and they have a cost price of $60 per unit. In the general journal, we credit the inventory account $120 to reflect a decrease in inventory. And we debit advertising $120 to recognize the advertising expense that we have incurred. Owners may also take home inventory for personal use. In this example here, the owner has taken home 1 pot for his own house. In the inventory card, this has been reflected in the out column. Here's a withdrawal of 1 unit of inventory with a cost price of $60 per unit. In the general journal, we record a credit of $60 to the inventory account to show a decrease in the inventory, and we record a debit of $60 to the drawings account to recognize that the owner has withdrawn the inventory for personal use. So this is how the inventory account will look like after all the movements have been posted for the period. We start off with the balance on the 1st of August, and here we can see that we had a balance of $240 worth of inventory at the start of the month. We record this on the debit side because inventory is an asset to the business. On 5th of August, there was a purchase of inventory which we record on the debit side. On 7th of August, 2 units were returned to the supplier. This decrease is recorded on the credit side. On 12th of August, 3 units were sold to a customer. This decrease in inventory is recorded on the credit side with the amount $180 recorded against the cost of sales account. On 18th of August, 1 unit was returned to the business by the customer. This is recorded on the debit side with the amount $60 and against the cost of sales account. On 22nd of August, 2 units of inventory were taken and used for advertising. This is recorded on the credit side with the amount $120 recorded against advertising account. And lastly, on the 27th of August, 1 unit of inventory was taken home by the owner for personal use. We record this on the credit side of the account with the amount $60 recorded against the drawings account. Here's a reminder to check the general journals for help with completing the cross-references. Now we need to balance the ledger account. To do this, firstly we take the total from the side with the larger amount, and this works out to be $780 on the debit side. Then we write this total on the other side, which is the credit side. Lastly, we calculate the differential amount on the credit side, which works out to be $300. This represents the inventory on hand that we have as at 31st of August. We then carry forward this balance to the 1st of September.